Now, if you listen to my previous video, which discussed Canadian personal tax and residency, then you do know that this video is going to be revolving around trusts and companies in Canada and what to do in order to leave Canada in the most tax-effective way. My name is Yelena. I'm a strategy manager here at Nomad Capitalist, and we help 7- and 8-figure entrepreneurs go where they treat it best. Now, when it comes to trusts and companies, everything in Canada revolves around management and control. As a rule, the determination of residency of a Canadian trust usually rests on where central management and control lies. That is, the tax residency of whoever manages or controls the trust will also determine the residency of the trust. In the past, control was generally considered to lie with the trustee or trustees. Now, if you're the only trustee, then you changing your tax residency could also change the tax residency of the trust. However, in case where more than one trustee is involved in exercising central management and control, the trust will be deemed to reside in the jurisdiction in which the more substantial central management and control actually takes place. The second complication to take into consideration is a recent ruling from the Supreme Court of Canada, which opened the door to the idea that a beneficiary can in some cases wield significant control over the trust. So even if you are only a beneficiary or a settler of a trust and not a trustee, you still may have enough control over the trust so that your tax non-residency in Canada means that the trust is also a tax non-resident there. So if you're leaving Canada for tax purposes and you have a trust in Canada, there are three options that you can do. The first option is to leave your trust in Canada and let it be considered a resident of Canada. In this case, the trust will still be normally taxed in Canada. However, you will be subject to 25% non-resident withholding tax on your share of any income earned through the trust. The second option is that your trust becomes a non-resident trust. So when you go from being a tax resident of Canada to being a non-resident, you are subject to a deemed disposition of certain assets, as we discussed in our previous video. And this same process will take place if a trust goes from being a resident in Canada to being a non-resident trust. All the property in the trust will be considered to have been disposed of at the fair market value, which can result in capital gains and trigger tax. Only a case-specific determination of residency would definitely establish the location of central management and control, and thus the tax resident of the trust from the perspective of the Canadian government. So we would generally always recommend analyzing your situation with a Canadian attorney to determine tax residence of your trust if it were to stay in Canada while you depart Canada. In addition, a trust that is deemed a non-resident trust in Canada will be subject to Canadian tax on Canadian sourced income on the same basis as any other non-resident person. Now, the third option is that upon your departure from Canada, you could also choose to dissolve the trust, in which case you would need to work out the most tax beneficial way to extract the money and assets from the trust before closing it down. Now, when it comes to companies, again, the most important thing is control and management. And upon your departure, you can choose a couple of options of what to do with your company. You can continue to operate the company as a personal tax non-resident of Canada, with the company being deemed a tax resident or a tax non-resident of Canada. So you have two options for the company's tax residency. Or the second option is to wind up and dissolve the corporation before you become a non-resident of Canada. Now, Canada imposes a tax on corporations differently based on the status of the majority of the shareholders, as either resident or non-resident. If you, as the sole shareholder of your company, cease to become a resident of Canada, then the corporation will likely do so as well. In case this happens, as mentioned, you will be deemed to have disposed of your shares in the company at a fair market value and to have immediately reacquired them for the same value. This may result in a capital gain tax and generally could result in a much higher tax rate for the company. If your company remains a tax resident of Canada, it will be taxed normally in Canada, and you will be subject to withholding tax for non-residents on the income you take from the Canadian company. Now, the second option that is available to you when departing Canada is to wind up and dissolve your corporation. The remaining assets and liabilities in the company will generally need to be zeroed out on the financial statement and corporate income tax returns. This will likely result in a deemed dividend payable to you. The investments held in the corporation can either be sold off or transferred to you personally. However, either way, this will result in a capital gains tax on the corporation's final income tax return. So if you're considering becoming a tax non-resident in Canada and you have a more complex structure or a more straightforward case, we would love to help you in both cases. These are some of the general rules that you should definitely be aware of, and we can assist you further in exploring them. What you would need to do is just head over to our website and apply to work with us using our easy application form and take the first steps towards your financial freedom.